Okay, so we'll get into this right away. We're going to react to Graham Stephan's video on his predictions for 2024. And I will say that these are only our opinions. So do your own research on anything that we say and anything Graham Stephan says. And I will also say that we're cheating a little bit because we're already done the first third of 2024 and he went into it at the beginning.
It's the best way to do it.
Yeah.
We have more information. Also, this is the first reaction video we're doing, so leave comments. Let us know how we did.
Yeah. Okay, so here we go.
All right, so to start, what makes this year so much different from the last is the fact that we're facing completely opposite conditions than 2023. Like, just consider that for the last 2 years, the Federal Reserve has been raising interest rates to combat inflation. And now we're seeing those interest rates decline for the first time since early 2022. In addition to that, 2024 marks an election year, of which tends to be pretty volatile. Another government shutdown is looming in just a few weeks, except this time it's going to be more difficult to kick the can down the road even further. And most importantly, nearly every single asset class is close to its all-time high, and worrying investors who wonder, how much higher can this possibly go? Honestly, all of this has added a really confusing layer on top of everything else, because even though this last year has heavily favored the investor, prices don't just go up forever consistently without some bumps along the way. Not to mention, if you look at the market throughout the last 2 years, it's essentially been completely flat. So in terms of where to begin, let's start here.
So one thing I want to comment on is I think that Graham Stephan is an index fund guy. He's like John is a Bogle. He's like a John Bogle guy, right? So you go in index funds and you just leave it in for 20 or 30 years. Of course, he also has youth on his side.
Right.
So, I mean, it makes a lot of sense. So he said that the stock market's been pretty much flat for this. And it has been if you're in index funds. But if you're a value investor, then it hasn't really been flat.
Right.
Because some of our positions, mainly Meta and oil, have definitely not been flat.
No, they've appreciated substantially.
Right. So it's always important to remember like what type of investor you are. Because if you're an index fund, your portfolio is going to look very different than if you're actively managing it. Yeah. A lot of people are probably actually down, which I think he gets into later, but we'll keep going.
Sure.
Average American is absolutely horrible at investing. In fact, statistically, the typical return that most people achieve is just barely higher than the rate of inflation.
Okay, let's talk about that.
Okay.
So why would you think that the average American or just person is worse than the average return in the market?
Probably patience. People don't have patience. Well, Warren Buffett has said most people don't actually either read financials or know how to read financials. So essentially he's compared it to playing poker without looking at your cards.
Right. But we actually as investors appreciate that the average person is worse than the market because that gives us an opportunity to invest and
which
to
is
make
what
money.
he's also said too.
Yeah, exactly.
Business Insider released an article explaining why the average investor does so poorly or even loses money despite prices going higher. And just for context, by the way, this article was written when the S&P 500 had fallen to 1,820. However, despite this in hindsight being one of the best opportunities to buy into the stock market, the average investor instead sold and waited for the market to recover, except in doing so, they missed out on some of the best moments of the entire decade. I mean,
Peter Lynch has said that, I can't remember the exact period, but if you had missed the, I'm going to call it 20 or 30 or 40 most or best days in the market from a span of about 20 years, you basically missed all the returns. And I can't remember exactly what the numbers were, but basically time in the market beats timing in the market, generally speaking, because you can't call when those times are going to be.
No, exactly. And also, and he said that. He's like, you don't know exactly what's going to happen.
No.
And the other thing is we just had a conversation because we were talking about the fact that so many people don't do well in the market. And we were saying, and a lot of people who are very intelligent don't do well in the market.
Right.
So we just had a conversation just, you know, personally, how EQ is so much more important than IQ when it comes to investing.
Right.
And
people get scared out at the bottom, then they sell their shares, and then the stock appreciates, and then they don't want to buy it back.
Exactly, and exactly what he said. Why is it that people are selling?
Right.
Right? Why are people selling at the bottom and buying
fear.
at the top? And it's that EQ.
Yeah.
I'm sure we've all probably seen the same chart showing what happens when you're out of the market during the best days over the last 20 years. But what I personally found the most surprising is that during that time frame, only 40 days were responsible for whether or not you make or lose money. That's it. And as they...
Okay, so imagine you don't check your portfolio. There's only 40 days, right? You open your portfolio, let's say January 1st one year, you open it the next year, and you only ever check it January 1st.
Yeah.
You probably would have no idea how volatile these past few years have been.
No, you wouldn't have no clue.
Right? And I know Warren Buffett says, like, I want to invest in stocks where if the market shuts down, I don't care because
for 10 years.
For 10 years, a decade, I don't care because my companies are doing well. And it's interesting. I think he said 40 days. 40 days were the best days, but you miss if you're checking the market every day. I can see why there's a temptation to like sell your bad position.
Well, I would say to further that point, oftentimes people will invest in real estate and they'll do well, but they'll invest in stocks and do poorly. The same person. And the reason is liquidity.
Right.
So with stocks, you push a button and it's sold. With real estate, you have to call a broker, you pay large commission fees. So there's hurdles there from selling. So you're beholden to this asset class, i.e. the real estate, for long periods of time. You can't, people would probably do poorly in real estate if they could flip it the same way they could flip stocks too.
Yeah, if they had someone outside saying, your house is worth $500,000 today, and then 2 minutes later they're saying, your house is worth $495,000 now.
Yeah. Now you're also a fan of, there's an anecdotal story about an individual and his wife who both took broker recommendations. And basically the wife beat the husband's return by going on the recommendations of the broker, but she bought and never sold.
So her husband had the broker and she would ask her husband what he was buying. And then she would copy the buy.
Right.
And then she never asked him what he sold.
Right.
So she just held every position and she way outperformed her husband at the end
because the trading didn't actually add any alpha.
They say missing these days does so much damage because those missed gains aren't able to compound during the rest of the investment holding period. Likewise, there's also the finding that the best performing days come right after the worst performing days, as you could see here. And on a more practical level, they even analyzed fund inflows to see exactly why investors were underperforming the market by a lot. And as I'm sure you might have guessed, they found that inflows became most aggressive as markets peaked and outflows ramped up when markets were near their lows.
So I just want to say a quick saying. I think it says you are in a recession when your neighbor loses your job, and you're in a depression when you lose your job. And I think that kind of touches on that. People see the market going up, they want to go up, and we actually knew that we had hit the top, or that we were getting close to the top. And I shouldn't say we knew, because in hindsight we knew, and maybe we would have been wrong, but we knew things were getting frothy when everyone we talked to was all of a sudden doing their own investing. People who had never been in the market, and all of a sudden they're talking about NFTs, and they're talking about...
And the gains they're making.
And the gains they're making, and it seems so easy, and everyone was making money. We're like, something's not seeming right. And this is an exact example of that.
Making money shouldn't necessarily be easy.
Investors consistently bought assets that were overvalued and sold assets that were undervalued. So what does this practically mean for 2024? Well, that's why I've always approached the stock market as a long-term investment strategy with...
So basically what he's describing there is FOMO and fear.
So you say the greed index and the fear index.
The fear index. So people buy when they get greedy, and they buy because they can't stand to watch other people make money. And then they sell when things are low because they can't stand losing money.
So what is the cure for that?
Contrarianism.
Yes. And also I think there's that saying be fearful when others are greedy, and greedy when others are fearful. So that's the anecdote there.
Money that I don't intend on touching for at least 20 to 30 years. That way, any of the day-to-day fluctuations really...
Okay, that comment is exactly why, if there's anyone watching who is young, you are in a way more advantageous situation than we are. Because 20 to 30 years for us puts us at 60 or 70. we can barely enjoy our money at that age. But 20 years for him probably puts him at our age.
Yes.
So it's pennies on the dollar for him. And just if anyone's young out there, just take note of that, because saving and investing is much easier because you have time on your side.
Also, it also speaks to the psychology of investing. If you have money that you're using to pay rent, don't invest it.
Right.
Because you don't have time for that money to play out.
Right.
So from that standpoint, you should be investing money into the stock market. You don't need to touch 5, 10, 20 years ideally.
Right.
Because then you can fluctuate, or you can withstand the vicissitudes and the fluctuations of the market.
Yeah, I think I've heard that you shouldn't invest money if you need it in 3 months.
Oh, no.
Yeah, like that's like just a bad idea.
Yeah.
Which...
really make no difference whatsoever. And once you zoom out, you'll see that it's pretty profitable to stay invested. For instance, one way to analyze potential returns is to look at what's called the rolling 20-year period of the S&P 500, which basically takes a snapshot to determine exactly how much money you would have made throughout every single time frame. And surprisingly, it's found that throughout the last century, a 20-year holding period has never once lost money. The reality is, the worst ever 20-year return occurred in 1948 at just under 4% a year, while the best year started in 2001 with the market earning more than 16% a year. It seems as though most years you'll tend to earn anywhere between 7 and 10%, but in the short term, the honest answer is anything can happen.
So let's talk about that for a second. So in investing, you have to compare the returns you're achieving to that which you could have elsewhere.
Yeah.
So in essence, if you as an investor are clocking your returns, then you should be clocking in at least 7 to 10% per year, compounded annually, in order to justify taking the risk of not being involved in the S&P 500.
Or you should, if you're not compounding annually at 7 to 10% a year, you should just index.
That's
because
exactly.
It's not worth your time to study.
In fact, if you're not getting that, you're actually losing out because you could be getting something better.
You're wasting your time and you're not making
and you're not making as much money as you
exactly.
You have a 73% chance of being profitable, which increases to 80% in the second year, 90% in the fifth year, and 97% in the 10th year, basically implying that the longer you stay invested, the more likely it is that you'll make money. However, I know some people are going to comment, but Graham, this year's an election year, and you have to take that into consideration for your video. And I agree. So here's the data. If we look back historically throughout the last 70 years, we could see that on election years, in the months of October, the market drops an average of about 1%. However, the good news is that on average, all of those losses are made up in the months of November and December, completely reversing any losses that occurred beforehand. Now, even more surprising is that overall, election years aren't all.
I think that's reflective of the market likes certainty. It doesn't like uncertainty. So once the result is decided, then the market's happy because there's some certainty there.
Right.
Just in general with regards to fiscal, monetary policy, etc.
I mean, even like, every time there's an election, you have the Democrats saying, last election or 2 elections ago, you had the Democrats saying, oh, if Trump gets in, the stock market's going to tank and we're all going to lose our money. And then the last election, the Republicans were saying, oh, if Biden gets in, we're going to lose all our money. And truth be told, the markets just kept chugging along no matter who gets in.
Well, and I think Buffett's quoted as saying something like, we've had, basically an even number of Republican and Democrat presidents. Yes, thank you. Presidents, and yet the market has still managed to perform just adequately either way. So it doesn't really matter who you get in there first.
But it makes for a good headline.
Yeah.
Not that bad either. And if we take a look all the way back to 1928, the market has gone up 19 out of 23 times during the entire year of the election. Now, that doesn't mean that past performance is going to happen again and again every single year, but it does indicate that if you stay invested, you're going to come out ahead more often than not. I also find it interesting that according to Ryan Dietrich's information on Twitter, the S&P 500 has so far always been positive in the year following a 10% drop and a 10% gain, meaning 2024 could be another fantastic year for investors. That's also echoed by the fact that besides the years of 1938 and 1963, when the market goes up by more than 20% in a year, it's always increased more in the subsequent year. This is exactly why I've kept the same mindset that it's probably best to dollar cost average into the overall markets on a regular basis, regardless of where it's priced. And if the past is any indication, there's a good chance that it's going to be worth a lot more in the future than it is today. However, in terms of what's happening with real estate, that is a completely different matter, and I hope you're sitting down because I certainly made some mistakes. Here's where things get really interesting in terms of the future of the housing market. Look, it's no surprise that the last 3 years have been incredibly challenging for anyone looking to buy real estate. Like low interest rates locked in new and existing homeowners, an inventory shortage kept prices high, and interest rate hikes absolutely
I know what you want to say.
I know what you want to say too. Was it about interest rates?
Yeah.
Yeah. So this is where Canada is very different than the US in terms of locking in interest rates. Now, we're obviously Canadian. With interest rates in Canada, you can lock in for a maximum of about 5 years.
We've never been able to lock in for 30 years.
No. And so my understanding is in America, you can lock in for 10, 20, 30 years in terms of a fixed percentage mortgage. So for those people, maybe 2-3 years ago, when interest rates were at their nadir, and they can lock in at maybe 1 or 2%.
Or zero.
Or 0.
0.5. I think it was super.
I don't know if anyone, there must have been a little bit more than 0. I don't know exactly what it was for them. But I think the mortgage rates in Canada hit a low of about 1.6%.
Yes.
So if we had the option to lock in at 1.6% for 30 years, we would have taken it Well, in fact, we did. We took it for 5 years, but that was the maximum that we could take.
Right, and that's going to that we're actually going to have
expire.
To renew in 2026.
Yeah, at a much higher rate.
Much higher rate, and we just don't have that same. Canadians do not have that same opportunity when interest rates are low to lock into real estate for 30 years. That is just not something that we have the advantage.
So interesting. It will be interesting to see how Canadian housing prices fare in that environment.
Yes.
Because with Americans, well, if you're locked in at a 1.6% interest rate for the next 30 years and you're happy with your house, well, guess what? You're not going anywhere.
Right.
Right? Why would you ever sell that asset when you're only paying 1.6% on it? In Canada, though, when the majority of people are going to start to end up renewing at interest rates of 5+%, maybe more, as opposed to 1.6%, things are going to look a lot different.
That's going to look a lot different.
Yeah, and so asset prices might come down.
Yeah.
Obliterated home affordability. But in 2024, that might begin to change. Why? Well, the 30-year mortgage rate is expected to drop as the Federal Reserve once again begins lowering interest rates. Or I guess more precisely put, it's expected that we're going to see 3 rate cuts in the next 12 months. There's also the aspect.
So there was just an announcement, and the Fed actually didn't lower rates, and people weren't expecting that.
Yeah.
And the interesting thing is they did say they're still planning to lower rates in 2024, but it's almost like a hope deferred.
Yes.
And it reminds me a lot of when we were in lockdown during COVID. And it's like, oh, we're going to take lockdown in this. And everyone's like, oh, 3 more months. And then it's like, oh, no, we're going to keep you locked down. Oh, 3 more months.
Yeah.
And I almost feel like it's more disappointing when the Federal Reserve says they're going to, and then they don't. Instead of just being honest from the get-go.
Yeah.
But we'll see. Maybe they're still going to do interest rate cuts during 2024.
Who knows? Yeah.
I mean, if they're serious about inflation at 2%, I can't foresee it.
I just listened to a video by Howard Marks, and he commented he doesn't ever invest based on the macro necessarily.
Most value investors don't. Investors don't.
And he said, if you asked me essentially to paraphrase him, he said, if you asked me what the interest rate's going to be 2, 3, 5 years from now, he said, I have no idea. And so he doesn't invest based on interest rates or things like that. He takes them into account, but he doesn't invest based on.
And neither does Warren Buffett.
Apparently neither does Warren Buffett.
Yeah, neither does Mohnish Pabrai and all those guys. Yeah.
So they can talk interest rates and whatnot all they want, but I mean, at the end of the day, I think as an investor, I've made that mistake in terms of trying to base my investing on that calculus. Now, having said that, I will digress a little bit and say, if interest rates are an extreme, you maybe best beware. So, for instance, when interest rates are 0 or negative at some point, if interest rates are low historically or negative as they were a few years ago for the U.S., maybe at that point you'd be a little cautious, stay out of the market.
I think interest rates too play more into real estate investing than
and bonds.
Which he never talks about. Actually, a lot of people don't talk about bonds, which leads me to think that bonds might be the play.
Yeah.
But that's, again, a different conversation. But I think real estate guys, I mean, obviously, when, like you said, if you can lock in at 1.6% for 30 years, that's going to really affect
what you're going to pay for a house. Yeah, absolutely.
But for the stock market, it affects it in the short term. It doesn't necessarily affect it in the long term.
Of significant pent-up demand to buy a property. And as the U.S. Census Bureau says, there would be 740,000 more homeowners if the homeownership rate matched the 1990 level. That's expected to generate many more sales as rates begin to come down throughout 2024. This is also expected to prompt a lot more homeowners to list.
Now, one curveball at the real estate market has been the recent Supreme Court decision with respect to real estate fees. So this is a bit of a sidebar. Real estate agency fees, basically,
which he didn't have access to.
Which he didn't have access to.
Coming in later.
Exactly. So that would be interesting to see how that affects housing affordability and prices, etc. So basically, the real estate agents are not allowed to charge as much commission anymore. I can't
comment. I don't know as much about
something to that effect, but it'd be worth examining how that affects things.
Yeah.
Their homes for sale once the gap between their existing interest rate and future interest rates begins to narrow. Although in terms of whether or not prices will fall, the general consensus seems to be, unfortunately, no, it's only going to get more expensive. In fact, it's said that more inventory will be generally offset by more buyers in the market. As a result, it's expected that overall, the median home price in the US will grow modestly, rising to $394,000 for 2024, a 1.5% increase over 2023. Of course, keep in mind that doesn't mean that prices everywhere are just going to be going higher, especially since real estate is highly localized, but because large...
Now, the interesting thing in Canada, and I don't have numerical data to support this, per se, but I know that the housing market in Canada has been historically over the past 10 years one of the hottest in the world.
Yep.
And I think that has a lot to do with supply and demand mismatch and whatnot. And I think a lot has to do with immigration numbers and things like that. So I'd be interested to see how our data plays out as opposed to the US data.
So I will say one thing to keep in mind with Canada is when we're talking about the hottest real estate, increases and our prices have gone just crazy high, that's mostly taking in only Toronto and Vancouver.
Yes.
There are a lot of provinces where housing is still semi-affordable.
Right.
Yeah.
Larger metros are facing some affordability issues. Areas like Miami, San Diego, Los Angeles, Las Vegas, Tampa, Nashville, Austin are in the locations likely to see a marginal price decline, while others like Indianapolis, New Orleans, Chicago, Pittsburgh, Detroit, and Louisville, yeah, I said that one correctly because I learned the hard way when I visited, could see prices increase as high as 5%. Now, on the other hand, Redfin believes that median prices will see a drop of 1% in 2024. Zillow thinks we'll see a drop of 0.2%. Morgan Stanley anticipates a price drop of 3%, and JP Morgan believes that affordability could be resolved by the time 2027 comes around. Now, in terms of what I'm doing though, I'll be honest, I have been completely blown away by the strength of the housing market and how resilient it's been. Like I said back in January of 2022 that I wanted to get back into the real estate market by buying where I live in Las Vegas through some commercial real estate. So I looked and waited, and I looked again, and I tried to find a deal that made sense to buy, and I kept waiting, and here I am. I'm still waiting. Now, in hindsight, it seems as though I've somewhat made the right choice because commercial real estate values here in Vegas have declined.
I think there's something to be said for being patient.
Yes.
I think there's a lot of wisdom in his comment there. If it doesn't make sense, oftentimes we as investors feel like we got to be doing something with our money. And so you may make a bad deal. No deal is better than a bad deal. So I think for him just saying, I waited and waited and waited and waited and came up empty-handed, basically, I think from that standpoint, he's exhibiting the behaviors of a good investor, essentially. He's examining and looking for deals, but couldn't find any. So you don't have to swing at everything.
No.
As Warren Buffett would say, there's no called strikes in investing. So if you see something that just doesn't make sense, don't do it.
I think the other thing to take away, and this is very wise, and we've learned by mistake, is he wasn't forcing it. Mm-hmm. He wasn't chasing it.
Right.
He was waiting, like you said. And sometimes, again, as investors, you really want to be in a certain company or you really want to be in a particular asset class. Mm-hmm. And so you start chasing it or you start forcing it for it to make sense. Maybe, you make your discount rate lower or you start fudging numbers to make it seem like it's going to cash flow. Mm-hmm. But if you chase it or you force it, it's usually going to come back to be a bad investment.
And bite you in the butt. Yeah.
Anywhere between 10 and 20% depending on the property type. But that's also meant that I've spent 2 years trying to find a no-brainer deal to buy, and that deal just has not existed.
I like the term he uses, no-brainer, because usually it's a good investment when you can say it was a no-brainer. I didn't even have to think about it. And for us, when oil went negative, when the cost of a barrel of oil went negative, it was a no-brainer for us to invest in oil companies because we knew that negative oil prices was not sustainable.
Well, despite all the negative narratives surrounding oil, electric cars are going to make oil obsolete, and you could look and say, well, a lot of that's just utter nonsense because it just was obvious that people were still driving gas cars around.
Exactly.
And they just were still going to need oil.
Exactly.
On top of that, though, the high interest rates also make a cash flow negative unless you put a lot of money down. And the risk-reward ratio...
I have actually seen people justify why buying property, even if it's going to be a cash flow negative investment, makes sense.
Just because of capital appreciation.
Because they say that the capital appreciation of the property will make sense for the cash flow negative. And to me, that is bananas.
Well, what they're doing is basically investing on hope rather than what is reality.
Exactly.
And unfortunately, most oftentimes I think hope doesn't necessarily pan out the way it's hoped for. Sometimes it does, and sometimes it's better than you'd ever expect. But when it cash flows, at least you know exactly what you're getting.
I think it's Deeper Pockets podcast that says when they invest in a property, the cash flow is just, or the capital appreciation is just icing on the cake.
That makes sense.
They only invest because of cash flow.
In isn't penciling out unless you're willing to do a lot of the work yourself. That means I'm going to continue being patient until eventually, hopefully, if I am lucky, the right deal will come along, and make sure to subscribe so I keep you posted on that. And finally, we have the last topic that's worth discussing because people have been asking me nonstop to talk about this, and that would be alternative investments, including Bitcoin. I mean, I think it's no surprise that I keep a percentage of my portfolio in more speculative alternative investments, including collectibles, cars, and Bitcoin, and I generally have the mentality that if it goes up in value, great, and if it doesn't, well, that's okay too. But I also can't say that I've not been paying close attention to what's going on with Bitcoin.
Okay, so we also have a position in Bitcoin. Very tiny. I think it's maybe 5% of our holdings, maybe less. And it's grown into that. It's not because we originally put 5% in. Very speculative, very risky, and I think he'll probably go on to say that the same thing that we're saying. Very speculative, very risky. Yeah. But, alternative investments are fun to dabble in from time to time if you can afford to lose the money. And
they have made returns. I mean, so for instance, people invest in fractional ownership of art. I mean, that's a thing, whether it's a good investment or not. I mean, I think it depends on what you're getting, and I mean, you have to know what you're purchasing in that arena. We know someone personally who invests in collectible cards.
Yeah, and he is good at it.
And he's very good at it, and he's actually made significant returns on his investment from doing so, because he knows he can purchase it at one price and sell it at a better price, and he's just very, very good at it.
He's very good. And I think for us too, one of the reasons we stay so small in Bitcoin is because we actually don't understand it fully, so it'd be foolish for us, but we do know people who are 100% in crypto, and they also do good at it. Yeah. So it's, again, staying in your wheelhouse, and for us, we just don't see it as an investment, but definitely don't want to miss out on it, so we do have some money invested in it.
Because it's incredibly interesting. Throughout 2023, the price has increased from a low of $16,500 to now more than $42,000, making it one of the highest returning assets of the year. This in and of itself is quite significant because the average cost basis for investors is shown to be around $33,000, meaning the average investor is now sitting in profit for Bitcoin. On top of that, even the
So does that make you nervous? The average investor is now sitting in profit for...
A little bit, because at what point do they cash out?
I know, like, you can't, it doesn't go, like he said, you don't have like continuous increases in the stock market. You don't have continuous increases in any asset. In the long run, things tend to always go up, but like not continually without bumps and busts.
Yeah, I mean, I guess some of that is related to the ETF acceptance of Bitcoin and whatnot.
Maybe the interest rates, the
inflation rates. So people are maybe playing it as an inflation hedge, and that. Unfortunately, with something like Bitcoin, there's no actual intrinsic value to it. So you're kind of playing on people's sense of what is it worth. So I agree, that is a bit of a concern. Kathy Wood has actually said she thinks Bitcoin is going to go to like $1 million a coin, which...
She made one good call with Tesla.
I mean, maybe not, I don't know. But to me, that seems a little insane.
Yeah.
Bitcoin bull MicroStrategy is back in the green with a cost basis of $31,000. Now, in terms of where this could go from here, some analysts believe that the Bitcoin ETF excitement is already priced in, and if it gets approved, prices might begin to fall. But as far as what I think, I have absolutely no idea. I've just taken the approach.
I will say the ETF thing has happened. So again, we are further into the future here from him. So we have a benefit reacting to this video, but also there's a halving coming up. I think a lot of people think it's going to be this month. It's April 1st today, 2024. Yeah. That will definitely affect the cost of Bitcoin. So we'll just leave that there.
So we'll stay tuned.
Yeah.
That Bitcoin can make up a small part of my portfolio, I don't see the harm in buying in on a regular basis with what you could afford to lose, and if you're going to buy in, it probably helps to have a very long-term outlook. As far as anything else though, to be honest, I really haven't bought any other alternative investments since the beginning of 2021. To me, there is just way too much hype around exotic cars and expensive watches, so I stayed away from that and chose to lose money in individual stocks instead. Just kidding. But in all seriousness, if I were to make any predictions for this next year, I tend to believe that automobiles still have more room to fall. Watches selling obscenely over MSRP makes absolutely no sense to me, and Bitcoin so far has been quite profitable to dollar cost average into. But time is going to tell how all of these play out.
So why don't we give our predictions and end our reaction video with our predictions for the remainder of 2024. Okay. Let's do stock market, real estate, and Bitcoin. You go first. Okay, so I'll go first. So
Sure.
I think Bitcoin is going to hit 100,000 USD.
Okay.
And then I think it's going to tank. And that's going to be okay with me, and I'm going to hold it, and it's going to go back up again. But I think it's going to get pushed. There's going to be hype. There's going to be the halving. People are, like he said, people are going to see it go up, and they're going to be like, oh my gosh, I'm missing out. And it's going to push it up even further. And I think it's going to push up to 100,000 before year end USD. That's my prediction.
Okay.
Definitely could be wrong. Do your own homework. Do not take my advice. In fact, I know very little about cryptocurrency. Stock market. Oh, the broad stock market. So SPY is 520-ish today. I haven't looked, but it's around that where we broke through the SPY 500. It's just been chugging along this year. You have interest rates are high. Inflation is being stubborn. I don't have a prediction. That's tough. It could go either way. It's going to be really short term. It's going to be really dependent on if the Fed does, in fact, lower those interest rates. Long term, who knows? Long term, it's going to go up because generally history tells us that long term it's going to go up. But if I have to make a prediction, okay, let's just throw something in there. I'm going to say that SPY hits 600 before year end at some point.
Okay, that's a bold prediction.
That's a bold,
so another 10%.
Another 10%.
Wow, 15%.
I'm going to say that when Michael Burry said that we are the best generation of buying the dip, I say we're going to push it up to 600.
Okay, so another 15% up.
Yeah, but I also think, that being said, I think it's going to do the same thing as Bitcoin. But you know what? Maybe I'm just like, my predictions are silly because, I mean, you always go up and then down. So, But let's just leave it there. SPY 600. Housing. Okay, so I'm going to talk about the Canadian housing market because that's all I know. I think the Canada housing market, if interest rates stay the way they are, I think it's going to correct. Not a lot because it's just... I think that the housing market is going to correct somewhat. I think we're going to see more so in Canada... We're going to more see like cabins, like that kind of real estate really come down in price if interest rates stay the same. I think it's going to be hard. There's a lot of government meddling in Canada when it comes to real estate. But I really think that we're going to see housing prices come down, especially the more they meddle in rent controls. People aren't going to want to buy them anymore as a cash flowing asset. So I could see a real estate correction coming in.
Okay, my turn, I guess.
Yeah.
In terms of the broad market, I could see it appreciating modestly. I'm not sure I'm quite so bullish as you are, but I could see it appreciating modestly depending on what happens with interest rates in the short term.
You're more bearish, naturally. I'm more bullish.
Yeah, and I think if they decide to cut interest rates, I could see it appreciating modestly still because I think a lot of that's probably already priced in because that's the expectation. If they decide not to cut interest rates, I could see actually the market correcting a little bit. So from that standpoint, I don't see anything on the horizon that's going to necessarily tank the market unless geopolitics gets involved, at which point, all bets are off.
Black Swan
events happen. And the funny thing is, if you could argue they're not really black swan events if they happen with regular frequency. Yeah. But who knows, China invades Taiwan or Russia, something happens there, who knows. So I can see it appreciating modestly, to maybe staying somewhat flat. That would be my prediction. In terms of the real estate market in Canada, I think at this point I could see it also remaining somewhat flat, stagnant, just because I think if interest rates go down, people are maybe going to be a little more prudent with their borrowing. Canadians are already over-leveraged, so from that standpoint, even if interest rates do drop, I don't see a huge appreciation in the housing market.
We're way more over-leveraged than Americans. I think a lot of people don't realize that.
I think people will take the lowered interest rates as a bit of a reprieve, and I don't think they're going to necessarily increase their spending because I think the lenders will also maybe be a little bit more tight in terms of their lending. So I think from that standpoint, I can't see much in terms of appreciation in the real estate market in terms of housing. In terms of other things like cabins and vacation properties and things like that, they might correct a little bit. I might agree with you there. Again, same thing. People may be taking these lower interest rates as a bit of a reprieve and renewing, but I don't think there's going to be a lot of increased spending in that regard. In terms of Bitcoin, I have no clue. I could see.
Say, like, between the two of us, I'm more the crypto. I enjoy looking into the cryptos. I enjoy studying them. I am more bullish on cryptos than you are. You're much more conservative investor than I am.
Yes, and I think at this point with regards to the cryptos, I could see it having a significant rally from here, but I do agree it tends to have booms and busts. So after a boom usually comes a fairly large bust, and I think that cycle will continue on. When will it happen? At what price point will it happen? I have no idea. So I think in terms of a means of exchange, I see the value of Bitcoin. people have said try to, send a gold bar to somebody. Well, can't be done, right? Even transferring money in a bank account to somebody else is difficult. Sending Bitcoin, not so difficult. In terms of, I could see it also having value in terms of, people wanting to hold it instead of their own native currency in certain areas. So in places where geopolitical occurrences are happening and whatnot, putting some money in Bitcoin makes a lot more sense than holding their own stable currency. So that might push Bitcoin prices up a little bit. But in terms of the long run, could it hit 100,000 American? Yeah, I could picture it. If it does, I agree. There's probably going to be a correction if it does that.
Yeah, and if it corrects, I'll be buying more.
Yeah, and like he said in his video, at this point, most people are above board on Bitcoin. So that does lead to profit taking, especially if there becomes some little cracks in the foundation. At that point, you're going to see some panic selling because people will justify the selling based on the fact that they're still above board.
They don't want to lose there.
And funny enough, that 30 some odd thousand US price point might be a bit of a floor.
Yeah,
because if you get
that.
people because of that. So if people are above board there, they start selling a little bit, taking profits, they might just buy back in because that was their initial cost basis. That's my thesis.
Okay, that was our very first reaction video. If you like that style, leave your comments. We would love to hear your feedback. And remember to like and subscribe because it helps our video. Thanks for watching, and we will see you next week.